All right, now we should be recording. All right, well, thank you guys for coming and virtually to this. I figured it'll be a little bit easier to grab some lunch and sit either at your home or your office, listen to this, then drive in parking downtown. So I'm trying to do one of these a month just to keep you guys informed and keep on our series. Just trying to help you guys be that consummate professional and move more towards advice for your clients, especially as we see this shift in our economy and the housing market. So put together this presentation, just talk about the economic background and what that means for you. Obviously the news is going over a ton right now, and they're selling fear. I mean, that's really what sells in any news cycle is the fear of a recession. And the word recession just invokes fear because of our most recent big recession that we had. So I really want to give you guys more background as to the history of recessions. And I have three goals today that I want to leave you with. I want you to know the data behind why they're predicting a recession that's coming up. I'm also going to email out this presentation, so you'll have the info either on your phone or on your laptop, that if you have a client who's hesitant, you can show them some of these slides. I'm also going to record this video we're recording now. We'll put it on YouTube. That way you guys can always send them that link as well if you'd like them to see it. And lastly, I just want you to feel comfortable talking with clients about the recession and what that means for them buying a home, either today or in 6 months or 12 months, and really show them by the end why it's not as scary as they think it may be. So first slide here, kind of just talking about, obviously in the news is saying we're going to see a recession. So this is 4 major surveys that were done in the last couple of months, and currently 86% of economists are predicting a recession by the end of 2021 is when they're predicting that it will begin. So typically they're seeing some data and seeing some numbers in our economy that's predicting this and why they think that. So that's kind of why we're going to go through a couple of things here. So the inverted yield curve, I keep hearing that term tossed around, and that's a very important thing to be looking at, but I don't think that people are explaining it very well. So I'm going to try and simplify it, because obviously we want to keep things simple to be able to explain it to others. But basically, when you're thinking of yield, you're thinking of a return. So I have an investment and I want to get return on my money, right? So this chart here, the yield going up and down on the left axis, that's how much my return is. And then this bottom axis is how long my investment's for. So typically in the inverted yield curve, when we're talking about it, what's indicating a recession coming is we're talking about bonds, okay? So the longer I'm going to invest in something, normally, you can see the word normal up here, normally I'm going to get more of a return than a shorter investment. Well, why is that? Well, if I'm going to lock up my money for, let's say, 10 years, I want a higher return, because what if in 2 years rates are higher? Well, I can't pull my money out of it. I'm locked in for 10, right? So I want a little bit higher return than if it was, say, a 2-year. Well, what we're seeing now, and why they're talking about the inverted yield curve, is where you can actually get a higher yield or return on a shorter maturity investment or bond. So a couple of weeks ago, and they're not inverted currently, the 2-year and the 10-year Treasury are not inverted as of today. But they were a couple of weeks ago, where you could invest your money for 2 years and get a higher return than if you invested it for 10 years. Well, why does this happen? Well, investors are assuming that if we enter into a recession, they're going to see lower rates coming up, or sorry, higher rates coming up. And so if they can not tie their money up for a long period of time, then they'll be able to reinvest it once we get out of the recession and see the higher rates. So it just really depends on their time frame with the money. But this is what they mean by an inverted yield curve. And I'm going to go over here in the next couple of slides why this typically indicates that we have a recession coming. So these gray bars here are the time periods that we've had recessions in the past. So this chart only goes back to the 1980 recession, but you can see this red line here at 0. So anytime this chart goes under, this is the 10-year minus the 2-year. So anytime it inverts or goes below, it indicates a recession. Doesn't happen 100% of the time, but it's, as you can see here, we'll go through. So the 1980, we inverted, we had the recession, we were above it, inverted, recession, we're back above, inverted, recession came shortly after. We inverted here, but it bounced back. So that, like I said, it's not 100%. And then right here, we inverted, recession came soon after that. And then inverted, recession came after that. So right here, where we're at now, we're starting to see it flirting with that inverted line. So it's not fully inverted. Like I said, today, it isn't, but it was a couple weeks ago. So it came out a bit, a little bit. Okay. So this slide is just showing where Treasury yields are at. These are already outdated. Obviously, they're moving every day. So I just kind of want to show you, if you do see some of these numbers, what it means. So if I'm investing in a 1-year, I'm getting a higher premium than a 2-year. And typically, they're looking at these 10-year and 2-year difference. So in this picture was from, I think, a week ago. You know, you're getting less on the 2-year, but when you see this 10-year go below the 2, that's the big one that they're looking at. Currently, as of yesterday, the 3-month and the 10-year are still inverted, and the New York Fed came out and said that to them, that means that there's about a 38% chance of a recession in the next 12 months. Another big indicator of a recession coming is when we look at the unemployment rate. And so there's been a lot of talk about unemployment rates being super low. In August, the number was 3.7%. The Fed came out today and talked about their projection is to hold that 3.6 or 3.7% unemployment rate, which is super low historically. And you can see here on the chart, here's where we're at right here. But again, the gray bars indicate a recession. This chart goes back a lot further than 1980, so back to the 1940s here. But as soon as you see us start to go back up in the unemployment rate, so here it bottomed, start to tick back up, we saw a recession. We hit a bottom here, tick back up, we saw a recession. Same. Whoops, same right here. Bottom, tick back up, recession, bottom, tick back up, recession. So just for your guys' knowledge, as you start hearing the news reporting or the Fed coming out and saying, hey, unemployment's now at 3.8, 3.9, 4%, we're starting to tick back up. That is 100% trend, as you can see here over the last 70 years, that a recession is coming. Okay. So now that I've kind of given you some of the background and some of the data that economists are using, I want to put it into terms that you can use when you're working with clients, because typically their biggest fear that they're looking at is the fresh in their mind 2008 crash of the housing market. So as you look at this chart, we have the last 5 recessions and how home prices did during those. And as you can see, up until 2008, you were really actually gaining value, or 1991, negative 1.9%. It's basically breaking even. You know, that's not really losing too much value. But then in 2008, we saw that negative 19.7, which was huge. So 2 questions regarding this chart that we're going to go over in the next couple slides is, first one was, well, why was 2008 an outlier? I think that's really important to cover because that's fresh in people's minds, and people they don't know what happened in 1980. Half the clients we're working with right now weren't born in 1980 or 1981. Some of them were born in 1991. So they don't have that historical perspective. And even some of the clients that were alive, they don't remember what happened back in 1980 during the recession. You know, it's always hard times, but they don't remember what happened to their home prices. So that's why it's important to show them why 2008 was an outlier. So in order to do that, and why I keep getting the question, I know you guys get the question too, is, well, are we heading for another real estate bubble? Or you know, is it going to be the same as 2008? This chart shows that very well. So this chart was put together by the Mortgage Bankers Association, and it tracks mortgage credit availability. And basically what that is they put together an analysis of how easy or how hard it is to obtain a loan, and then they put numbers to it. So you can see here in June 2004 is when they started tracking these numbers. It was a little bit under 400 on their index. And then over the next 4 years, it topped out close to 900, which meant that it was very, very easy to obtain a home loan. I wasn't doing home loans at that point in time, but you know, a lot of people joke, you know, you needed to fog a mirror, have a heartbeat to get a loan at that point, but you didn't need both, right? So we were seeing loans that were called stated income, where you would just walk in and say, yes, I make $100,000 a year. And then they'd say, okay, great. We don't need to verify that. Here's your loan. You know, definitely we've changed a little bit since that. As you can look at this chart, we dropped off in June of 2008. We were a little bit above 100, got a little bit looser, got a bit tighter. And then right now in April 2019, we still haven't even got back above 200. I've been in lending, you know, since 2011 here. I remember the tight days. We have loosened up a little bit, but you know, as you can, most borrowers right now, sometimes it's a little bit annoying. We have to source down payment money. We have to make sure that you actually have a job and you're still working there. So what that means is that the people that are buying houses today, they can afford them. And you know, they're not just buying multiple investment properties, which was happening back in 2005, 6, and 7, where you'd have a bartender buying 15 investment properties on stated income because the market was appreciating so much that he was hoping that he'd be able to pull his cash back out or get them rented. So there's a huge difference, and being able to articulate this to clients is a big deal, because the reason why we had the bubble on the previous screen was because of these loose lending practices. We don't have these anymore. And so that is not going to set us up for another huge housing crisis. And the housing crisis is what led to the last recession. Okay. So back to my previous question. So why does real estate do so well in the recession? Oops. I'm just going to show you. So the numbers again here, we had 6.1, 3.5, about even, and then 6.6. Actually, we're going to get back to that question here in a second. This goes more towards the my previous slide that was showing about the standards. So this is just showing in March of 2018 to March of 2019 where we're at with delinquency rates. And you can see they're actually improving year over year. And right now, this number just staggers me, is in foreclosure. 0.4% of all mortgages on homes right now in the US. That's a super, super low rate, and it's all-time low. And that's even including, you know, the wildfires in California, the floods that we've had. Those houses sometimes go into foreclosure as well. So that's including all of those homes. So that's just another piggybacking on how solid our housing is in America right now, and why we should not see another bubble like we have. Okay, so on this slide, we're just showing over the last 50 years. Basically, this red line is evening out the lows and the highs. But as you can see, this line trend, you know, through the recessions, we keep seeing these increase in home prices, little dip here, little dip, rebounding, you know, big increase here, dip, and now we're already higher. So when we're getting those questions about, well, what are home prices going to do? Or what I keep hearing more recently is, hey, I'm going to wait for the real estate market to pull back. You know, we're at all-time high prices right now. I'm going to wait for it to pull back. Well, this is a great one that I'm going to give you guys this slide as well to have in your pocket and say, you could wait for them to pull back, but here's historically what home prices do over the last 50 years. And then these gray bars, again, are a recession. And so you can show them during a recession may not be the time that they're going to pull back. So you may be waiting quite a while if the recession doesn't start till the end of 2021. And then it could last 5 years, it could last 1 year. So really depending on time frame and how much people are putting into rent, that'd be a huge one to show them. So question earlier was, why does real estate do well in a recession? So the way that the government helps get us out of a recession is by manipulating interest rates. We've had artificially low interest rates for a long time now. December of 2018, we saw the highest that we had in a very long time, almost 5%. We've already dropped about 20% since then. And right now, the last couple of weeks, we've seen us sliding back up to the low fours. But, high threes, low fours right now is where most people are at when they're purchasing a new house. And so really important to explain that to clients is, hey, rates could potentially continue to go lower. As we get into a recession, we're going to see lower rates. That's how our economy is going to come out of the recession. And so that just sets us up for a perfect storm. If we can have the lower rates, that increases affordability for clients. But if they're going to wait until after the recession, then they're going to be looking at higher interest rates. And then just the affordability of the same house, even if the price comes down of the house, the rate has a much bigger impact on their monthly payment. And so, a lot of my education piece is showing them the actual numbers. And as we have a case-by-case basis, we can show those clients the actual numbers. So even if they get a little bit cheaper purchase price, but they get a higher interest rate, in the long run, they're actually worse off. So just, again, continuing to educate them. But this is a good one to show, during each of these recessions, dropping from 16 to 11.75, 18 to 13, 11 to 8.75, 7.375 to 6.75, and then 6 down to 4.875. And then obviously they went lower, and now we're starting to tick back up. So what does that mean going into this next recession? Well, like I said, rates have room to go even lower. And most economists that I follow are predicting lower rates. And in fact, they're predicting possibly the lowest rates that we've ever seen. So over the next 2 years, we could be seeing 2.99 or very low 3% 30-year mortgage rates. Well, why is that? Don't want to geek out too much on the economics of it, but right now, if you're looking across the world at some of the major economies, Switzerland, Germany, Japan, Netherlands, and France, they're all negative interest rates. So if you're buying their government bonds, you're going to get back less money than what you gave them in a return. Even if you're the most novice investor, you can see right away that's not a very good investment. So you're not going to want to buy their bonds. So you could be looking around the world and saying, well, the US has bonds that are paying higher yields or returns on my money, so I'm going to go over there and buy those. Well, that's going to start pushing our prices higher, and price and rates are opposite of each other. So it's going to start pushing our rates lower. And that's why the economists that I'm following, they're predicting we're going to see lower rates, especially as the rest of the world, as their economies struggle and they keep lowering interest rates to try and boost their economy, it's going to lower our rates as well. Okay, so I'm going back to this slide because I want you to have this in your pocket. And again, I'm going to send this out to everybody. But really kind of just want to wrap this up in going back to where I want you guys to be the consummate professionals. Right now, our industry is changing. So you guys in the real estate industry, you're competing with the iBuyers. Zillow's trying to buy everybody's house. They're trying to cut you as the realtor out. But all they can do is sell price, right? So like we compete with Quicken because all they're selling is price. So what we can do is we can give advice to our clients which is way more valuable than just selling them the lowest interest rate or the lowest price for a house or the lowest in fees. So you guys can overcome the 3% conversation by giving advice and earning the trust of your clients, which is ultimately what we're here to do, right? We, as the professional, want to have that client for life, and we want to help them grow their portfolio in real estate. So Quicken's just there for the one-time transaction, or Zillow's just there to get their house cheap and flip it. So helping clients see that and being there to advise them, especially anybody can help them in a booming market that's going up. But as there's fear and uncertainty, being able to advise them and give them, the correct information and give them the data that supports it, that's going to set you apart. Plus, if we start seeing interest rates dropping, and then maybe next year we have some more inventory, that's going to be a perfect storm, to help you guys have maybe your best year ever in real estate. The purchasing power is going to be there for clients. There may be clients that kind of got burnt out this year that signed a lease, and then they're going to come back next year, and it's going to be a great environment for them to buy in. So going to be sending this out to everybody, but please reach out to me if you have any questions. We're not going to take questions here since we're recorded, but happy that you're able to join, and please let me know if you have any questions, and I'd be happy to answer them for you. I'll talk to you all soon.